Comfort feels good. In life, it's the easy job, the familiar routine, and the safe choice that gives you peace of mind. But over time, comfort also limits growth. Investing is no different. We all crave stability, and that sense that our money is protected. So we build portfolios filled with what feels safe: fixed deposits, government bonds, and maybe a few blue chip stocks that will never fall. They look predictable, they sound responsible, and most importantly, they help you sleep at night. But here's the truth: comfort isn't the same as safety. It just feels like it. These comfort assets aren't bad by themselves. They serve a purpose. They help you feel calm enough to stay invested. But most people confuse low volatility with low risk. Just because an asset doesn't move much doesn't mean it's truly safe. Low movement can just mean slow erosion. And the real danger isn't price swings, it's inflation. Every year that feels quiet and stable may actually be a year where your buying power shrinks. When comfort becomes the core of your wealth plan, it turns into a trap. Because while your money sits safely parked, the world and prices keep moving. So the real question isn't, is my money safe? It is my money growing fast enough to stay safe?
Let's decode it in this episode of Decoded by Qode.
Let's do some simple math because numbers don't lie. Say your fixed deposit pays 6% a year. Now remember, FD interest is fully taxed as income. After a 30% tax, that 6% becomes roughly 4.2% in your hand. Then inflation takes away another 5%, leaving you with almost zero, maybe even a negative real return. Meanwhile, equities are taxed differently. Long-term capital gains are taxed at only 12.5%, which means more of your gains stay invested and keep compounding. So even though your FD balances grows on paper, your purchasing power shrinks in real life. That's the hidden cost of comfort, which is quiet, invisible, and working against you. Now stretch that over time. Imagine investing 1 lakh rupees for 20 years. In a FD at 6%, you will get 3.2 lakh rupees after 20 years. But adjusted for 5% inflation, it's worth just 1.2 lakh rupees in today's money. Whereas an equity portfolio at 12% will give you about 9.6 lakhs. In fact, a high growth portfolio at 18 to 20% will give you 27 to 38 lakh rupees. A 2 to 3% difference in annual return becomes a 40 to 60% difference in total wealth. And if that 18 to 20% return sustain for 20 years, your capital doesn't just double, it multiplies 20 to 25 times. That's how compounding quietly rewards those who stay invested in growth. Comfort feels safe in the short term, but over the decades, it quietly guarantees underperformance. Even safe blue chips can trap you. Think of ITC. Between 2013 and 2020, a steady business, strong balance sheet, yet the stock barely moved for 7 years. That's not loss, that's stagnation. Real risk isn't volatility. The real risk is permanent loss of your purchasing power. Comfort doesn't protect you from risk. It only keeps you from growing. So how do you escape the comfort trap? How do you protect your money and still let it grow? The answer isn't taking big risks. It's learning to live with a little uncertainty, the kind that builds strength over time. That's what we call intelligent discomfort. Here are 3 simple steps to do it without losing sleep or peace of mind. Safety doesn't mean don't do anything. In investing, sitting still is like parking your car and expecting it to reach your destination. Real safety is when your wealth grows faster than inflation and taxes, not when it hides from them. Everyone needs a little comfort. It helps you stay calm when markets move. but too much comfort keeps you stuck. Keep a small part, maybe 10-15%, in low risk liquid assets for emergencies. That's your safety net. But the rest should be working, spread across different types of assets that grow at different speeds. That's how real safety is built, through diversification, not avoidance. Because comfort protects you today, growth protects your tomorrow. Markets will always move. Some years will be calm, others will test your patience. That's why it helps to decide things in advance. How much risk can you take? When will you rebalance? And how long will you stay invested before judging your results? Once those boundaries are clear, you stop reacting to noise. You let logic, not headlines, guide your choices. And over time, something changes. The market's ups and downs stop feeling scary. They start to feel normal, like rhythm, the heartbeat of compounding. That's intelligent discomfort, not fearless investing, but thoughtful investing. Not chasing safety, but designing it. Because true safety doesn't come from avoiding movement. It comes from staying diversified, patient, and invested long enough for those movements to turn into returns. Most investors don't lose money by making bad decisions. They lose it by making comfortable ones. Comfort feels mature, it feels responsible, but over the years, it quietly creates a gap between what you have and what you could have had. That's the hidden cost of comfort. It doesn't look risky, it just looks still. Real wealth is built on patience, discipline, and staying invested. When things feel uncertain, markets will swing, cycles will turn, and comforts will always whisper, wait till it feels safer. But compounding doesn't wait. It rewards those who stay in motion, those who accept a little discomfort today to buy freedom tomorrow. And real growth, it always lives just outside of comfort. So, how do you keep your investment safe? Let us know in the comments below, and don't forget to like and subscribe to Decoded by Qode, where we enable data-driven financial growth that shapes legacies.